The American dream has always been painted with a particular brushstroke. Go to college, earn a degree, and financial success will follow. For millennials, this wasn't just advice, it was gospel. Parents saved for years. Guidance counselors made it sound inevitable. Politicians promised it would pay for itself. But somewhere along the way, the golden ticket became a golden cage, and millions of young adults found themselves trapped in a system that seemed designed to benefit everyone except them. Let's start with the numbers, because they're staggering. By 2026, total U.S. student debt had climbed to $1.87 trillion. That's not a typo. $1.87 trillion. And this debt was spread across 43 million borrowers, many of them millennials, who are now in their late 20s through early 40s. To put that in perspective, that's more debt than the entire auto loan market in America. More than credit card debt. It's a crisis that's hiding in plain sight because it doesn't have the drama of a stock market crash or a bank failure. It's distributed across millions of individual lives, each one a small story of broken promises and delayed dreams. So how did we get here? The story starts in the 1980s and 90s, when college tuition began its relentless climb. The federal government had pulled back on funding public universities. States followed suit. The burden shifted to students and families. Meanwhile, colleges responded to this new reality by raising tuition even higher, knowing that federally backed student loans would always be there to fill the gap. It was a perfect storm of incentives, all pointing in the wrong direction. For millennials, the message was crystal clear. A bachelor's degree isn't optional, it's mandatory. Without it, you'll work minimum wage your whole life. You'll be poor and desperate and alone. The messaging was relentless and terrifying. So students borrowed. They borrowed for tuition. They borrowed for room and board. They borrowed for living expenses. Some borrowed more than they needed because, well, the money was available. Why not? You're supposed to be investing in yourself, right? Here's where the trap really tightens. When you graduate, you don't owe the principal amount you borrowed. You owe interest too, and not just a little bit. Federal student loans carry interest rates that compound. This is crucial to understand because compounding is where the real damage happens. Imagine you borrowed $30,000 for your degree. That's around the national average for a 4-year degree. Your interest rate is maybe 5%. That seems reasonable, right? It's lower than a car loan or a credit card. But here's the thing, you're not paying that 5% once. You're paying it every year on whatever balance remains. If you make minimum payments, most of that payment goes toward interest, not principal. In year 1, you owe $1,500 in interest. In year 2, you might still owe $1,400 because you've only paid down $1,000 of principal. The debt shrinks slowly, while interest keeps piling up. Now let's add another layer of complexity that makes the trap even more inescapable. Most millennials who borrowed for college didn't graduate into a booming economy. The oldest millennials entered the job market right as the dot-com bubble burst. Younger millennials graduated during the financial crisis of 2008. The job market was decimated. Entry-level positions disappeared. Starting salaries dropped. Many graduates couldn't find work in their field at all, so they took jobs that didn't require a degree. They were overqualified and underpaid, stuck with 6-figure debt and 5-figure salaries. This is where the math becomes genuinely cruel. If you borrowed $50,000, but you're only earning $35,000 a year, you have a problem. Your minimum loan payment might be $500 a month. That's 1/3 of your gross monthly income, before taxes, before rent, before food, before everything else. For many borrowers, making the full payment isn't actually possible, so they fall behind. They miss payments. Late fees accumulate. The debt grows faster than they can pay it down. Some borrowers turn to income-driven repayment plans, which sound like a lifeline, but often become another trap. With these plans, your monthly payment is capped at a percentage of your discretionary income. Sounds good, right? The problem is that while your payment is lower, the interest keeps compounding. In many cases, you're paying so little that your outstanding balance actually grows each month. You're paying, but you're falling further behind. It's like running on a treadmill while it keeps getting faster. There's also the psychological weight of this debt that economists rarely mention. Student loans follow you everywhere. They affect your credit score, which impacts whether you can rent an apartment, buy a car, or get a mortgage. They hang over every decision you make. Want to start a family? Student debt makes it harder to qualify for a mortgage. Want to buy a house? Your debt-to-income ratio just shot up. Want to start a business? Banks won't lend to someone already drowning in debt. The financial cage keeps getting smaller. And here's a particularly cruel twist. If you default on your loans, the federal government can garnish your wages. They can take money directly from your paycheck before you ever see it. They can intercept your tax refunds. They can pursue you for decades. Private loan servicers, meanwhile, have even more aggressive collection tactics. This isn't a normal debt. This is a debt with teeth. So where does this leave millennials? Many of them are in their 30s and 40s now, and they still have student debt. Some of them have been paying for 15 or 20 years and somehow owe more than they started with because of interest compounding. Some of them have paid $50,000 toward a $30,000 loan. They're exhausted, they're angry, and many of them feel utterly betrayed by a system that promised them so much and delivered so little. The path forward isn't simple, but it's not impossible either. We need to acknowledge that this is a systemic problem, not an individual failure. Borrowers didn't create this situation through recklessness. They were sold a bill of goods by a system that benefited from their debt. Students didn't set tuition prices, or cut public funding for universities, or create the perverse incentive structure that rewards colleges for raising costs. Understanding this is important, because shame has kept many borrowers silent. Second, we need real policy solutions. Loan forgiveness programs exist, but they're complicated and incomplete. Public service loan forgiveness, for example, promises to forgive loans after 10 years of working in government or nonprofit sectors. That sounds great, but it's notoriously difficult to navigate. Borrowers have found that their servicers lost paperwork, that payments they thought qualified didn't count, that the promised forgiveness never materialized. The program needs to be fixed, not scrapped. Beyond forgiveness, we need to address the underlying issue, the cost of college itself. Tuition has grown far faster than inflation for decades. It's grown faster than wages. It's grown faster than almost any other cost in the American economy except healthcare. This isn't sustainable. Some countries have figured this out. Germany eliminated tuition at public universities. Norway did the same. Many developed nations treat higher education as a public good, not a private commodity. There's no reason America can't do the same. We also need to make federal student loans actually federal. Right now, they're serviced by private companies with massive profit incentives. These companies have every reason to make repayment difficult, because it means borrowers stay in debt longer and pay more interest. If the government serviced loans directly, the entire incentive structure would change. Efficiency would increase. Fraud would decrease. Borrowers would actually get accurate information about their options. Another crucial step is reforming how we talk about the purpose of higher education. For decades, we've treated a college degree as primarily a financial investment, like a stock or a piece of real estate. You buy it, it goes up in value, you sell it for a profit. But education is also a public good. An educated society benefits everyone. When we treat it purely as a private investment, we shift all the risk to individuals, most of whom are teenagers when they make the borrowing decision. That's inherently unfair. We also need to create better alternatives to traditional four-year degrees. Trade schools, apprenticeships, community colleges, and certificate programs can provide valuable skills and lead to good careers without the crushing debt. There's no shame in these paths, but our culture certainly treats them as inferior to a four-year university degree. That cultural shift needs to happen alongside policy changes. For people currently trapped in the debt cycle, there are some practical steps they can take. First, understand your loans. Know whether they're federal or private. Know your interest rate. Know your repayment options. Many borrowers don't even know what they owe or what options exist. Second, if you have private loans, consider refinancing if your credit score has improved since graduation. You might get a lower interest rate, which means less money going to interest and more going to principal. If you're in an income-driven repayment plan, pay attention to the income calculation. Report your income accurately. If your income drops, recertify immediately. There's also a strategy called income-driven repayment, paired with aggressive principal payment. Make your required income-driven payment, then put every extra dollar you can find toward the loan with the highest interest rate. This breaks the compounding cycle. It takes discipline and sacrifice, but it works. You have to be willing to live below your means, at least for a while. For recent graduates or people considering college, the message needs to be different. If you're going to borrow for college, borrow strategically. Go to an in-state public university if possible. Work part-time to reduce borrowing. Consider starting at community college for general education classes. Live at home if you can. every dollar you don't borrow is a dollar you don't have to repay with interest, compounding for 2 decades. But here's the difficult truth. Individual solutions aren't enough. This is a systemic problem that requires systemic solutions. It requires changes to federal policy. It requires changes to how universities operate. It requires changes to how we value education and who bears the cost of providing it. One borrower making smart decisions can't overcome a broken system. The trap exists because powerful interests benefit from it. Universities benefit from high tuition. Loan servicers benefit from borrowers who stay in debt. The financial industry benefits from the interest payments. Policymakers have historically been reluctant to confront these interests. But the pressure is building. Millions of borrowers are angry. Political candidates are forced to address it. The current system is becoming politically unsustainable. What gives hope is that this situation didn't emerge inevitably from natural forces. It was created by policy decisions made over decades. And if it was created by policy decisions, it can be unmade by policy decisions. We have proof that other approaches work. We have models from other countries. We have examples from our own past, when college was more affordable and public funding was prioritized. The millennials who borrowed for college weren't foolish or greedy. They were hopeful and trusting. They did what they were told to do. They followed the rules, and the rules were rigged. That's not their failure. That's a systemic failure that we all share responsibility for fixing. The first step is recognizing that this is a crisis. Not a crisis for deadbeats or failures, but a crisis for millions of hardworking people who were sold a promise that wasn't kept. The second step is understanding how it happened so we don't repeat it. The third step is demanding change. Not just token gestures or incomplete reforms, but real, structural change that addresses the root causes and protects future generations from the same trap. The golden ticket wasn't counterfeit. It was real. It represented real opportunity and real education and real growth. But somewhere along the way we put a price on it that most people can't afford to pay. And we're all paying the cost of that mistake, whether we borrowed for college or not. Creating a system where education is accessible, affordable, and not weaponized as a source of perpetual debt isn't radical. It's basic justice, and it's what we should be working toward.